So what are ETFs? This is essentially what I just said, but they are designed to track something, okay? So an index, if you will. An index tracks things. So for example, it tracks, in the case of VCE, we're tracking companies in Canada. In the case of VOO, we're tracking companies in the States. In the case of, like, let's say a gold ETF, right? You can have a gold ETF. We're tracking a commodity. Likewise, I know we had Amy asked to talk about Bitcoin ETFs. They're tracking either Bitcoin or various cryptocurrencies, okay? Another thing they can track is a theme, if you will. So responsible investing, like ESG, which is environment, social governance, or a halal investment. So they're tracking something, okay? So the key, I write here, the key feature of an ETF is that you are able to buy one share. So one share of VCE, one share of VOO, one share of XEQT, whatever the heck it is. And in that one purchase, you're buying a basket of securities. You're not just buying one security. And why this is important is because one security can fail. It inherently has something called company risk. You were betting on the company. So for example, let's use just Martha Stewart, just popped into my head, okay? If you were to bet on Martha Stewart before the whole jail thing went down, you would have seen, what's her company called? Martha Stewart International something, I don't know, but whatever it is. Her bad reputation, the stock plummeted like 95%, right? So that's a risk. One company, one person screws up and your entire portfolio goes down if you're invested in Martha Stewart. Again, that could happen with anything. Enron's another perfect example. So to avoid that, we buy an ETF. One purchase, a lot of companies, okay? Easy way to think about it. So the next question is, how do ETFs differ from mutual funds or individual stocks? So the main idea, flexibility. Okay, so what that means is you can go onto an exchange, and what an exchange is, it's the marketplace. So the Toronto Stock Exchange is an exchange. It's a marketplace where you go to buy securities. The New York Stock Exchange is another exchange, okay? So you go onto this exchange, you buy the ETF that you want, but again, it's liquid. So we call it, there's a lot of liquidity in, well, I shouldn't say. There's a lot of liquidity in the ETFs that we're buying. We're not buying illiquid ETFs, and that's something we'll talk about later on when we start analyzing them. But they're buying and selling all the time in the market, okay? So if you buy them, this is great, but a lot of the time you buy something, like you buy an illiquid security. I used to trade illiquid securities as a profession. I used to trade mining stocks. And I would be on my Bloomberg terminal, which is where you see all those little things going up and down, and I see all the buyers and sellers in the market, and there are no buyers. So for example, our fund wanted to sell 1 million shares of a mining company. Well, I can't sell them if there's no buyers. So it could be worth $50 a share. If there's no buyers, it's worth nothing because you can't offload it. So that's something we're always thinking about, is this idea of liquidity. It's great if I can buy it. It's easy to buy something. Everybody wants to sell you something, but if you can't sell it, that's a problem. So again, the ETFs that we talk about and that I recommend, they're very liquid, very, very liquid. And again, we'll talk more about that later. So lower costs. This is the biggie, everybody. And I want to really, really spend some time talking about this. When you look at an ETF or when you look at any fund, and it's funny, Irina and I were looking over this yesterday, a traditional mutual fund that your bank would put you in. We just looked up a random TD mutual fund and it was 2.3% MER. Okay, I'll just keep that in your head. I Googled like what's the most popular BMO mutual fund. So I went to the BMO, mutual fund page and I looked at their look, you'll see BMO Managed Balanced Portfolio Series A. That's one that they would recommend to their clients. Always remember, your fund advisor at BMO, your fund advisor at Royal Bank, wherever you bank, in the States, here, they don't work for you. They work for the bank. They make their money by selling the bank's products, all right? Very important for you to know. Now, let's look at this MER. It's called the Management Expense Ratio. When we start looking at fund fact sheets, that's the first place my eye goes. It's just, again, I beeline for the MER. So that's what I want you to train yourselves to do. Beeline for the MER. Now, for context, something Common, just like we said, the TD, the BMO, an MER of 2% is not uncommon. It's actually pretty standard. This one I pulled up is low, 1.89. But for context, that means for every $10,000 you have invested, every year the fund takes $189. Okay? Now that $189, remember, that's every single year. And that's eating away at all of your profits every single year. We talk about compounding, right? That exponential growth and how returns snowball towards those latter years. Well, fees snowball the same way, right? Fees snowball the same way. So they get huge. And again, you'll laugh when you see this example. So again, an MER of 1.89 means I pay the fund $189 on every $10,000 investment. On the other hand, VOO, which is a common one that we talk about often, it's the S&P 500 for our Americans online. I think we do have some US participants. VOO is the S&P 500, the top 500 companies in the States. It's sort of like the staple, ETF by Vanguard. It's the company that you would ever want to invest in. Its MER is 0.03. So again, for context, $3 on every 10,000 versus 189 on every 10,000 per year. Okay, whatever. It doesn't seem like, well, but what's $186? I'll show you what $186 is. Go online anywhere and look up what's called either a mutual fund calculator or a fee calculator. They're all over Google. It's not hard. So I just, did this a couple days ago. I'm like, let's look for fun. Let's actually use those two funds. So VOO being the 0.03 MER, and then that, 1.89% Series A fund, whatever the one that, was it BMO? I can't remember. I think it was BMO. Yes, because I'm BMO. So I just looked at BMO. So let's compare those two, okay? This is a scenario. You, me, I wanted to choose a reasonable scenario for our community. So let's say you start off with $10,000 and you just invest that $10,000 in the mutual fund and you contribute $1,000 a month. I realize that might be a little bit aggressive, but it's realistic, right? So I'm using a conservative rate of return of 7%. Okay, that's S&P 500-ish. That's kind of what we expect the market to earn, 7% over a period of 40 years. Okay, the difference in your portfolio over 40 years is, so in the first scenario, you've put it in a mutual fund with BMO, that exact fund that I showed you. You did everything right. You did all of that. You end up after 40 years with $1.64 million. Same scenario, identical, thing that you're doing, $10,000, $1,000 every week, or every month, I'm sorry. In VOO, you've got $2.69 million. That's more than $1 million difference over 40 years. That's huge. And if we look, like if you can deconstruct, and we can do that today too, but if you deconstruct your mutual funds, so for example, if you're in a bank mutual fund, look at, that one that I used, that BMO as an example, or a TD or what have you, and you look at the fund fact sheet, they will have all the holdings inside the fund fact sheet. The second thing you're going to want to look at, and we're going to do it, is you want to look at the holdings. Well, you'll see that they're just buying VCE, VOO, but they're buying their version, their bank's version of these funds. So of course they want to make the money, and that's why they're charging, because they've constructed these products, so they have to pay someone who's running that product, and then they create a mutual fund where they buy all their own products, and then they have to pay the person running the mutual fund. That's why you're being hosed, I guess, is the word. Okay, look, if you're in a mutual fund, it's better than not being in anything at all. And a lot of the times our work, so for example, my previous job had me funneled into a very specific mutual fund. And then the second I was able to get out of it, I moved everything over to Wealthsimple. And my allocation is, like, full disclosure, I'm VCE, VOO, and VEU. So that's mine. Again, that's appropriate for me. And I've also got a little bit of private credit. But you know what I mean? Like, this is huge, right? So Beeline, MER, always check out the MER. So now, again, why ETFs are better over individual stocks? Well, diversification is the big one. And for those of you who don't know what diversification is, it's the idea of spreading risk. If we have one company, just like we used the Enron or the Martha Stewart example, very risky, because your entire portfolio, your well-being, your ability to take care of your children lies in the hands of one management team. And if they're doing stuff that's not so good, you know, a la Enron, that's your entire life savings down the drain. So that's a lot of risk that you're taking. So if we invest in ETFs, even VOO by itself, which is the S&P 500, that's 500 different companies. So God forbid Mark Zuckerberg or something does something fraudulent and you know what I mean, it goes to zero, you've still got 499 other companies holding you up. Okay, advantages. So what are these, the main advantages? And again, I'm going to go through these quickly, but I just wanted you to have this document sort of that you can always refer back to. Tax efficiency is one, and why that is, I'm not going to get into it in excruciating detail because it's not really that important. But when you're in a fund, every time the fund manager sells something within it, it triggers a tax event. So when you get your T3, I believe, at the end of the year, yes, it is a T3, your investment statement account, it's gonna show these redemptions and you're gonna have to pay tax on it. Whereas in an ETF, that doesn't happen just by virtue of the way it's constructed. Again, not important for our purposes. Liquidity, like we talked about, it's that idea of you can buy and sell easily. Mutual funds, you only sell at the end of a day and you have to go to your broker and they're gonna charge you to do this, okay? Liquidity for ETF, you can literally just go on to Wealthsimple or your discount brokerage with any of the major banks. Discount brokerages, by the way, do charge, so I suggest Wealthsimple because it's a free trade, so you kind of want to do it that way. Transparency is another one. Mutual funds, they are transparent, but not as transparent as ETFs. So, you know, you always kind of know what's going in there. Diversification we talked about, and lower expenses, again, in the form of MERs. So now we're going to get into the meat a little bit, and this